What if I told you there's a way to put an actual dollar value on your backup plan? Well, today on The Explainer, we're going to dive into a financial strategy that does just that. It literally turns those what if scenarios into real, tangible assets. And you know what? It might just change how you look at every single big decision you ever make. Okay, so you see this classic trade-off in business all the time, right? It's that fundamental choice. Do you save money right now, or do you protect yourself from problems that could pop up later on? So to make this really concrete, we're going to follow the story of a company called PharmaCorp. They were staring this exact dilemma right in the face. And their story, well, it shows how just a small shift in thinking can completely flip a project from a definite no-go into a strategic yes. So here's the deal. PharmaCorp needed a new factory to serve a growing market, and they had two very different paths to choose from. Okay, so option one, build a brand new factory in country A. The big plus, super low operational costs. But the catch, and it's a big one, was that it's in a geopolitically risky area with a pretty fragile supply chain. Then you've got option two, set up shop in country B. Now this one's gonna cost more to run, but it's stable, it's low risk, a totally safe bet. So that's the choice, right? Low cost now versus low risk later. All right, so let's first look at this through the lens of traditional business accounting. How most standard financial models would see this problem. Now, the standard tool for this is something called net present value, or NPV. It's really just a way to calculate a project's future profitability in today's money. Because, a dollar today is worth more than a dollar in 10 years. So here are the key numbers. You've got the initial investment, the expected cash flow each year, and how long the project will run. And the formula is pretty simple, really. You just take the total expected profit over the life of the project, in this case 10 years, and you subtract the initial cost to get it all started. And when you plug in the numbers, well, the results is a clear negative. We're talking a loss of over $15 million in value. Ouch. So, based on this single number, the decision from the board is simple. It's final. Reject the project. The numbers don't lie. Or do they? This is where it gets interesting. So you have to ask, what is this traditional model missing? It's missing something absolutely crucial, the value of having a plan B. And this is where the whole idea of a real option comes into play. Okay, so this is the core idea. A real option is the right, but not the obligation to take some future business action. The best way to think about it, it's like paying for business insurance. You're creating strategic flexibility and actually giving it a concrete financial value. So PharmaCorp, they decided to make a small $5 million investment. And what this did was make their Country B factory expansion ready for the next 3 years. They weren't committing to expanding. They were just buying the right to do it quickly, but only if they absolutely needed to. Now, what's really interesting here is how you can map this to a traditional financial option. In finance, you talk about an underlying asset and an exercise price. For PharmaCorp, the underlying asset is the value of future demand, and the exercise price, well, that's just the cost to expand the factory in country B. So, this begs the question, right? How much is this 3-year window of flexibility actually worth to the company? Can we really put a number on that? Well, using a valuation model, we can actually input some key variables. We've got the value of the potential demand, the cost to expand if we need to, the 3-year timeline. And this is the magic ingredient, volatility. Think of it as a number that captures all that risk and uncertainty, politics, markets, you name it. And check this out. The model reveals that the option to switch, that flexibility itself, is worth a whopping $28 million. That's the hidden value. Okay, so now we get to the final step. Let's take this new number and see how it completely transforms the original decision. So we're going to use what's called an expanded NPV calculation. It's pretty simple. You start with that original static NPV, you add the value of your flexibility, that's your real option, and then you subtract what it cost you to create that option. So let's plug in our numbers. We've got that negative $15.6 million from the start. Then we add the $28 million value of our backup plan and subtract the $5 million it cost to set it up. And look at that. The result is now a positive $7.3 million. This is incredible, right? The project is now clearly a winner, creating over $7 million in value.
I mean, the difference here couldn't be more dramatic. You've got the static NPV in the red at minus 15.7 million and the expanded NPV in the green at plus 7.3 million. The same project goes from being a definite no to a confident yes.
And this isn't just some accounting trick. This is a real governance tool. It gives leaders the financial ammunition they need to make strategic projects happen. It puts a concrete dollar value on resilience. And it makes managers accountable for actually, managing future risks and options.
So the real takeaway is this. The next time you're making a big decision, look beyond the most obvious path. Ask yourself, what hidden options are in this decision? Where is the flexibility hiding in plain sight? Because sometimes that's where the real value is.